Welcome to this interactive video on variance analysis. We've put this resource together to assist anyone involved in FP&A to get familiar with variance analysis, how it's defined, how it's applied, as well as go through the calculations you need to know to calculate the impact of price, volume, and mix. To do this, we're going to take a practical approach by using our free variance analysis template with a case study. Why are we doing this? Variance analysis provides you with the information to answer questions that will invariably be raised by the management team, board, and investors. But it's difficult to interpret. Understanding the effects of each of these key variables will help improve your handle on the cumulative performance of a business and its trends. That means your answer to questions that arise in reviews and board meetings will no longer include, "We don't have that information yet. We'll get back to you on that," or worse, "We're not sure." When FP&A professionals talk about variance, we're talking about how far off financial KPIs are from what was expected, rather than statistical variance. This video won't cover the math behind how price, volume, mix is calculated. But if you want to do a deep dive into how the equations are derived, we suggest that you read our how-to guide on variance analysis. For our case study, we present a SaaS business that has 4 software solutions. Each has a different price, a different number of units sold, and was introduced to the market at a different time. We set it up this way so that we can already expect that the contributions of each product in terms of price, volume, and mix will be different, as highlighted in this high-level overview of the company's performance in the first month. The prices shown represent the monthly values of the respective software solution. The volume represents the number of sales of each solution, and the mix is that volume expressed in percentage terms. Finally, the total column represents the revenue in the period, which is a function of multiplying price and volume. Now that we have the performance mapped out of our illustrated company, let's present the actuals for comparison purposes and dig into the effects of price, volume, and mix. From a total revenue perspective, the company has done well in accelerating growth overall. The total growth alone does not tell the full story of how and why the company got to where it did. To tell the whole story, we must isolate the effect of price from the effect of volume, from the effect of mix. A major driver of organic growth for companies, especially mature ones, is increasing price. Price increases can help generate significant revenue growth as long as customer demand holds. On the flip side, price cuts can have the opposite effect. To isolate the impact of price changes for each product, we calculate the difference between budget price and actual price, then multiply it by the actual volume for each solution. Why are we taking the difference and multiplying it by the actual volume? Because we are isolating the effect of price on the company's overall change in total revenue by keeping sales volume constant at the actual level. As we can see, 3 of 4 solutions had a higher actual price with respect to the budget price. These isolated price increases amounted to a combined price impact of $52,500. Here is an alternative view depicting the impact of price on revenue for an isolated software solution. For software solution 4, we can see that given the price decreases, there is a minus $5,000 impact resulting from the price change. Following the steps described here allows you to isolate the effect of price on the company's revenue. A key nuance worth noting: you must be sure that the prices used to calculate revenue are homogeneous across the volume. If there are different points across the solutions and volume data points utilized, this analysis would be masked by higher or lower averages. Another key driver of organic growth for all companies is increasing volume to both new and existing customers. Whether the company sells services, widgets, software, or any other product, selling more units is positively correlated with improvements in revenue. In the case of our illustrative company, we will want to focus on the volume of each software solution to customers in each period of analysis to determine the impact volume has on revenue. Similar to price, this can be summarized in a waterfall chart, as the one depicted here. In our example, the actual volume sold was more than the budget. Therefore, we'll have a negative volume effect. To quantify the effect by solution, we need to compare budget and actual revenue at budget mix. which is calculated as the revenue amount in case the company has sold 1,275 units, the same price and mix as that which was budgeted for. Let's look how to do these calculations. The volume of solution 1 is 15% of the total, which is calculated as 150 units divided by the total units. Therefore, the actual units at budget mix is 15% of 1,275 units, which equals 191. The actual revenue at the budget mix is the result of multiplying these 191 units by the budget price. Finally, the volume effect is calculated as the difference between actual revenue at the budget mix and the budget revenue. As a company grows, mix shifts can contribute to drastic changes in overall performance. This is because all products, services, revenue types, customers, and market segments are not created equal and have different unit economics. So, we need to understand the impact of sales mix and how it contributes to overall revenue. The mix effect component is calculated as the difference between actual units and actual units at budget mix multiplied by the budget price. We need to lay out a few additional columns and data points to dig into the impact of mix, specifically for actual units at the budget mix. Again, using software solution 1 as the example, we take the actual units minus the actual units at the budget mix, which gives us the mix impact on units. To calculate the mix effect, we simply take the mix impact on units and multiply it by the budget price, giving us around minus $20,000. As with all data analysis, variance analysis is only practical if you use it to course correct. There are 3 primary barriers that prevent you from achieving this. The first, analysis results come too late to make a difference in future actions. The accounting staff most likely analyze the variances at the end of each month in your company. Your management team will then receive the analyzed actual results, and while it may not be possible to speed up this process, your accounting team can flag any concerning findings before you finalize the formal reporting. In many companies, that feedback loop needs to be shorter for the data to be more meaningful. Second, variance analysis is labor intensive. Experienced financial analysts can conduct relatively simple, streamlined variance analysis. It will quickly tell you what the variance is, but not necessarily tell you why without more digging. This is where the process can become time-consuming. This is a worthwhile investment only if your team time uses the why information effectively and efficiently. Finally, budgets are not always the result of an objective, technical process. Often the budget is a function of competing interests, compromise, and company politics. When this is the case, what you will be comparing actuals to is not helpful. It is therefore essential that the budgeting process follows best practice and is a closer depiction to what is planned as possible. With OnPlan, you can overcome all these hurdles. Variance analysis is built-in and immediate, and integrations to your financial and sales systems ensure that actuals are always up to date. Building budgets that tie in sales, marketing, and product operational plans is easy, so your forecasts are realistic in the first place. Variance analysis can be as detailed as your financial models, and you can easily draw from variance to the source data to spot what's really going on. In other words, with OnPlan, variance analysis can be a daily, continuous part of your financial management practice and keep your company on plan.